Welcome to the Deep Dive. We're the show that cuts through all the noise, gets straight to the core insights, and brings them directly to you, our curious learner. Today, we are diving deep, like really deep, into something that feels like a hidden financial superpower, how you can seriously cut your tax bill and plan smart for healthcare costs. Not just for today, but, way down the line, too. We're talking about tools. Actual tools designed to put more money back in your pocket, making sure you know what's what without getting totally overwhelmed. So, our mission today, it's crystal clear. We're unlocking the projected tax savings you can get from two incredibly powerful, but often pretty misunderstood accounts: health savings accounts, HSAs, and flexible spending accounts, FSAs. We'll dig into the details, uncover some surprising perks, and most importantly, give you the practical know-how to actually use them for your financial planning. This deep dive, it's all for you. We're cutting the jargon, delivering insights you can actually use, stuff that makes a real difference.
Absolutely. And just so everyone knows where we're getting our facts, we've gone straight to the source. The official IRS publication 969. It's called Health Savings Accounts and Other Tax-Favored Health Plans.
Yeah.
This is basically the rule book. It's the bedrock for our discussion today. All the precise facts, the rules, the little details. It's all straight from the IRS. Our goal is simple: translate this official guidance into clear, actionable steps so you can feel confident using these tax advantage plans.
Okay, let's unpack this financial superpower then. At their heart, what are these special accounts really for? I mean, the government designed them with a really specific goal, right? To give people like you real tax advantages to help deal with, well, the rising cost of healthcare. It's kind of like the IRS saying, hey, if you save and pay for medical stuff smartly, we'll give you a tax break, rewarding financial responsibility for your health, essentially.
That's exactly it. Publication 969 actually mentions four main types of these plans. There are health savings accounts, HSAs, then medical savings accounts. Those are older, like Archer MSAs and Medicare Advantage MSAs. Also health flexible spending arrangements, FSAs, and finally health reimbursement arrangements, or HRAs. Now, the publication covers all four, but for this deep dive, we're really zooming in on HSAs and FSAs. Why? Honestly, they're the ones most people can actually use. They're the most common, most accessible for individuals and families today. And they are absolutely key to understanding those projected tax savings we mentioned for your planning.
And the really compelling thing, the core idea shared between them, is that basic tax advantage, isn't it? Whether it's an HSA or an FSA, the money you put in, it often goes in tax-free or you can deduct it. That's a win right off the bat. But then it gets even better when you actually use that money for qualified medical costs, taking it out. Those reimbursements also completely tax-free. It's like a double tax benefit, a really powerful reason to channel your health spending through these accounts. Okay, here's where it gets really juicy, I think, especially if you're thinking long-term, building a financial strategy. Let's kick off with health savings accounts, HSAs. So what exactly is an HSA? Picture it like your own personal savings account, maybe even an investment account, but specifically for healthcare and with these amazing tax perks. The IRS calls it a tax-exempt trust or custodial account. You set it up with a qualified trustee, could be a bank, an insurance company, an investment firm, and its whole purpose to help you pay for or get reimbursed for certain medical expenses. It's like your dedicated healthcare fund, and it can grow a lot over time.
Exactly. And what makes HSAs just so incredibly powerful, especially for that long-term planning piece, is what everyone calls the triple taxed advantage. It's a trifecta of benefits. You just don't see in many other places. Okay, first up, contributions. When money goes into your HSA, whether it's from you, maybe a family member, or even your employer, it comes with immediate tax savings. If you put the money in, or anyone besides your employer does, that contribution is fully deductible on your tax return. And what's really great about this deduction is it's above the line, meaning you get the tax break even if you don't itemize deductions using Schedule A. For a lot of people, that means instant reduction in taxable income, real money back. Now, if your employer chips in, maybe through payroll deductions with a cafeteria plan, that money, it's just excluded from your gross income entirely. And this isn't just about income tax. Often you avoid Social Security and Medicare taxes on those employer contributions too. That's like an immediate 7.65% saving on that chunk of money right there in your paycheck. Boost your take-home pay.
Okay, tax-deductible contributions, that's number one. What's the second part of the triple advantage?
Number two, tax-free earnings. This is where the long-term investment power really kicks in. Any interest you earn, any dividends, any capital gains from investments inside your HSA, it all grows completely tax-free year after year. This lets your money compound without getting hit by annual taxes, just like, a 401k or an IRA. If you can save and invest in your HSA for decades, that tax-free growth can build up a really substantial nest egg just for future medical costs, maybe even deep into retirement.
Wow. Okay, so tax-free contributions, tax-free growth. What's the third leg of the stool?
The third, and absolutely crucial piece, tax-free distributions. When you take money out of your HSA to pay for qualified medical expenses, those withdrawals, also totally tax-free. So think about it. Pre-tax or deductible money goes in, it grows tax-free, and it comes out tax-free for medical needs. That's the trifecta. It makes the HSA incredibly efficient for healthcare savings. Plus, and this is key, an HSA is portable. It belongs to you, not your employer. If you switch jobs, leave the workforce, retire, your HSA goes with you. It's a true long-term asset for your health and financial future.
Okay, those benefits sound, well, frankly, amazing. Almost too good to be true. But like anything with big tax perks, I'm guessing it's not for everyone. There've got to be rules, right? Who actually qualifies? What does it mean to be an eligible individual for an HSA? This seems like a critical first step for planning.
You nailed it. Eligibility is the most critical piece. It's often where people get tripped up or miss out entirely. You absolutely must meet several very specific conditions to contribute to an HSA. The big one, the foundation. You have to be covered under a high-deductible health plan and HDHP. And not just any time, but specifically on the first day of the month you want to make a contribution for. So what's an HDHP? Well, like the name says, it has a higher annual deductible than most typical health plans. It also has specific maximum limits on your total out-of-pocket costs for the year, things like deductibles, co-payments. But importantly, that maximum limit doesn't include your monthly insurance premiums. Those are separate.
Okay, high deductible health plan. Got it. Are there specific dollar amounts we should know? Like, what qualifies as high deductible?
Yeah, the IRS sets specific limits each year, and knowing them helps you see if your current plan qualifies or if you should consider switching. For 2024, if you had self-only coverage, the minimum annual deductible is $1,600, and the maximum out-of-pocket cost, including that deductible, is capped at $8,050. For family coverage in 2024, the minimum deductible is $3,200, and the max out-of-pocket is $16,100. Now, looking ahead to 2025, these numbers tick up slightly. For self-only, the minimum deductible becomes $1,650, max out-of-pocket $8,300. And for family in 2025, it's a minimum deductible of $3,300 and a max out-of-pocket of $16,600. The exact numbers matter, obviously, and you should always check the current year's figures. But the main idea is HDHPs mean higher deductibles before the plan starts paying significantly.
Okay, higher deductibles, but does that mean nothing is covered before you hit that big number? What about checkups or preventive stuff?
That's a really important point, actually. An HDHP can still cover preventative care benefits before you meet the deductible, or maybe with a lower deductible, and still qualify you for an HSA. This is a subtle but huge advantage. The IRS lists examples of preventive care, routine physicals, immunizations, quitting smoking programs, weight loss programs for obesity, lots of screening services for cancer, heart disease, mental health, vision, hearing. It's a pretty broad list. And some recent IRS guidance, notice 2024-75 specifically, added some interesting items. Over-the-counter birth control, including emergency contraceptives and male condoms. They're now explicitly listed as preventive care and HDHP can cover without applying the deductible.
Wow, okay, so everyday things can be covered pre-deductible.
Exactly. That notice also clarified that things like breast cancer screenings for those not diagnosed, continuous glucose monitors for diabetics, and certain types of insulin are generally treated as preventive care too. This means your HDHP can help with routine health management without you having to drain your HSA first. It's a big deal for managing costs.
All right, so HDHP is rule number one. What else do you need for HSA eligibility?
Rule number 2 is almost as critical. You generally cannot have any other health coverage besides your HDHP. This catches a lot of people. But, like always, there are exceptions. You can have certain other types of insurance, like workers' comp, insurance for a specific disease, policies that pay a fixed amount per day of hospitalization, accident insurance, disability, dental, vision, or long-term care insurance. Basically, insurance for things that aren't comprehensive medical care. There was also that temporary rule allowing telehealth with a $0 deductible for HDHPs, but that specific relief ends before 2025. The really crucial part of this no other coverage rule is that having a general purpose flexible spending account, an FSA, or a health reimbursement arrangement, an HRA, will almost certainly disqualify you from contributing to an HSA.
Ah, okay. So you can't usually have an HSA and a regular FSA at the same time.
Generally, no. But, and this is vital for maximizing benefits, you can have specific types. A limited purpose health FSA or HRA. These only cover dental, vision, or maybe preventive care expenses. Or you could have a suspended HRA or a post-deductible FSA or HRA, which only pays out after you've met your main HDHP deductible. We'll circle back to this later because combining these the right way is a powerful strategy.
Okay, that makes sense. HDHP, no other disqualifying coverage. Anything else?
Just two more key rules.
Hmm.
You absolutely cannot be enrolled in Medicare, any part of it. And you cannot be claimed as a dependent on someone else's tax return. If you can check all those boxes, HDHP, no disqualifying other coverage, no Medicare, not a dependent access, then congratulations, you're likely an eligible individual who can leverage that triple tax advantage.
Okay, so you've run the gauntlet, checked the boxes, and you qualify. Awesome. The next logical question for anyone trying to save on taxes is, how much money can I actually stash away in this HSA each year? And what are the sort of strategic things to think about with contributions?
Right, the contribution limits are fundamental for planning your savings. For 2024, if you've got that self-only HDHP coverage, the limit is $4,150. If you have family HDHP coverage, you can contribute up to $8,300 in 2024. Looking ahead to 2025, those limits bump up a bit. $4,300 for self-only and $8,550 for family coverage. And here's a nice bonus. If you're age 55 or older by the end of the tax year, you get to add an extra $1,000 to that limit. It's called the catch-up contribution. So someone who's 55 with self-only coverage could put in $5,150 in 2024. Or with family coverage, that's $9,300 total. And remember, these contributions directly lower your taxable income. Immediate tax savings.
Okay, $1,000 catch-up for folks 55 and older. Good to know. Are there any tricky rules around contributions, things people might miss?
Yes, absolutely. There's a really important kind of complex rule called the last month rule and its related testing period. This is critical to understand to avoid potential penalties. Here's how it works. If you become eligible for an HSA, meaning you have qualifying HDHP coverage on the very first day of the last month of your tax year, for most people that's December 1st, you're actually treated as if you were eligible for the entire year for contribution purposes.
Wait, so even if I only get an HDHP on December 1st, I can contribute the full year's amount, like $8,300 for family coverage in 2024.
Exactly. It lets you max out your contribution for the year, even with just 1 month of eligibility. It's a huge potential boost for your current year tax deduction.
But, and this is a massive but, there's a catch. You must remain an eligible individual throughout a testing period. This testing period ends 12 months after that last month. So if you use the rule because you became eligible on December 1st, 2024, you must stay eligible all the way through December 31st, 2025.
Uh-oh, what happens if you don't? Like if your insurance changes mid-year in 2025, that's where it gets painful. If you fail the testing period, a portion of the contribution you made, using the last month rule basically, the part you wouldn't have been eligible for otherwise gets added back into your income in the year you failed the test, so 2025 in our example. And on top of that income tax, you also get hit with an additional 10% tax penalty on that amount. Let's make that real. Say Sarah, age 53, gets family HDHP coverage December 1st, 2024. She uses the last month rule, contributes the full $8,300. Great. But then maybe she loses her HDHP coverage in June 2025 because she didn't stay eligible for the full testing period. A big chunk of that $8,300, roughly 1,112ths of the difference between the family and what she might have contributed otherwise, or maybe just the prorated amount she wasn't covered for, gets added to her 2025 income, plus that 10% penalty. It can easily be a four-figure mistake.
Yikes. Okay, that's a serious warning. So that last month rule is powerful but risky.
It really is. Here's another quick example from the IRS guidance. Mark, 39, has self-only HDHP from Jan 1, 2024. He switches to a family HDHP on November 1st, 2024. Because he has family coverage on December 1st, he uses the last month rule to contribute the full $8,300 family limit for 2024. But let's say he loses eligibility in March 2025. Same problem. He didn't meet the testing period. So the extra amount he contributed thanks to the last month rule, above what he'd get prorated for Janox self-only and Novafart family, is added to his 2025 income, plus the 10% tax. The bottom line, the last month rule needs careful planning and awareness of your coverage for the entire following year.
Got it. What about married couples? How do the limits work if both spouses have coverage or want to contribute?
Good question. If either spouse has family HDHP coverage, then both spouses are treated as having family coverage for the contribution limit. The total combined limit they can contribute across both their HSAs is the family limit. So $8,300 for 2024. They can split this limit between their accounts however they want, maybe 50-50, maybe one spouse contributes at all, as long as the total doesn't exceed the family limit. Now, if both spouses are 55 or older and neither is on Medicare, each one can make their own additional $1,000 catch-up contribution, but it has to go into their own separate HSA. So a married couple, both 55 plus A, could potentially contribute a combined $10,300 in 2024, $8,300 family limit, plus $1,000 catch-up each. For example, say one spouse is 58, the other is 53. They have family coverage. They decide to split the $8,300 limit evenly, $4,150 each. The 58-year-old can add their $1,000 catch-up, contributing $5,150 total. The 53-year-old just contributes their $4,150 share. But remember that crucial Medicare rule. Once you enroll in Medicare, your HSA contribution limit drops to zero, instantly.
And if Medicare coverage starts retroactively, you might have accidentally made excess contributions, leading to penalties. Super important for planning around age 65.
Okay. Is there any other way to get money into an HSA besides direct contributions?
Yes. There's one other really interesting, though less common, method. A qualified HSA funding distribution from an IRA. This lets you make a one-time tax-free transfer directly from your traditional IRA or Roth IRA into your HSA. It's basically moving money from one tax-advantaged account to another. This can be a great way to boost your HSA balance, especially if you're getting closer to retirement and want more funds specifically for healthcare. The amount you can transfer is capped at your maximum HSA contribution limit for that year, including any catch-up.
So if I'm 57 with self-only coverage in 2024, I could move $5,150 from my IRA to my HSA tax-free.
Exactly. $4,150 base limit plus your $1,000 catch-up. It's generally a once-in-a-lifetime thing per IRA, although there's a small exception allowing a second transfer if you switch from self-only to family coverage mid-year. But just like the last month rule, this IRA transfer has its own testing period. You have to remain an eligible individual for 12 months, starting from the month you make the transfer. Fail that test. The transferred amount becomes taxable income and gets hit with a 10% penalty.
Wow, another testing period. So you could use the last month rule and do an IRA transfer and have two separate testing periods to worry about.
Precisely. It adds another layer of complexity you need to track. Powerful tool, but requires careful navigation.
Right, eligibility navigated, contribution limits understood. Maybe even use that IRA trick. The money's in the HSA, now what? How do you actually use it and keep that tax-free status? And what about records? What do you need to hang on to?
Excellent questions. The whole point of the HSA is to pay or reimburse qualified medical expenses. And crucially, these expenses must be incurred after you've actually established your HSA. You can't pay for old bills from before the account existed. So what counts as qualified? Generally, it's anything that would qualify for the medical and dental expense deduction if you were itemizing. Think IRS Publication 502 for the full details. It's broad. Doctor visits, hospital stays, prescriptions, dental work, eyeglasses, contacts, chiropractor visits, therapy, lots of stuff. And importantly, thanks to relatively recent changes since 2019, this includes over-the-counter medicines, things like pain relievers, allergy meds, cold medicine, even if you don't have a prescription. That's a big convenience.
Oh, wow. So I can use my HSA for Tylenol or allergy pills now?
Yep. And also menstrual care products, tampons, pads, cups, those are qualified now too. And as we mentioned, Notice 2024-71 recently confirmed that male condoms are also treated as medical care, so they're eligible for HSA funds. These expenses can be for you, your spouse, or any dependents you claim on your tax return. There are even some special rules for kids you don't claim, like adult children under 26 on your plan or children of divorced parents.
Okay, so most medical stuff is covered. What about insurance premiums? Can I use my HSA to pay my monthly health insurance bill?
Generally, no. Most health insurance premiums are not considered qualified medical expenses for HSA purposes. But again, exceptions. You can use HSA funds tax-free for long-term care insurance premiums up to certain age-based limits, COBRA continuation coverage premiums, premiums for healthcare coverage while you're receiving unemployment benefits, and very importantly for retirement planning, Medicare premiums, Parts A, B, D, and other health coverage premiums if you're age 65 or older, but not Medigap supplemental policy premiums. Those are specifically excluded.
Ah, okay. So using it for Medicare premiums after 65 is a key retirement benefit?
Absolutely. It's a major planning point.
Yeah.
Now, what if you take money out for something that's not a qualified medical expense? Maybe you need cash for a car repair. If you do that, the amount you withdraw is subject to regular income tax, plus a hefty 20% additional tax penalty. Ouch. That penalty, however, goes away if the distribution happens after you become permanently disabled, reach age 65, or after you die.
So after 65, if I take money out for non-medical reasons, I just pay income tax, like from a traditional IRA, but no 20% penalty.
Exactly. That's why people sometimes call it a backup retirement account. If you stay healthy and don't need all the funds for medical costs, after 65, it acts much like a traditional IRA for withdrawals, just without the penalty for non-medical use. Still incredibly flexible. One more warning. Prohibited transactions. Don't do things like pledge your HSA as collateral for a loan or buy property from yourself with HSA funds. These actions can blow up the whole account, making all the assets taxable immediately. Just use it for qualified expenses and approved investments.
Got it. Steer clear of funny business. Now, about those records, how important is keeping receipts?
It is absolutely paramount. I really can't stress this enough. You must keep meticulous records. Receipts, bills, explanation of benefit statements, EOBs. You need proof that every dollar you took out tax-free was for a legitimate qualified medical expense. You also need to show that expense wasn't reimbursed by insurance or anyone else, and that you didn't also deduct it somewhere else on your tax return, like as an itemized deduction. You don't usually send these records in with your return, but if the IRS ever audits you or asks questions, you need to be able to produce them immediately. Without records, those tax-free distributions could become taxable income, and you might face penalties. It's non-negotiable. Keep everything organized. Digital copies are great.
Okay, keep good records. Makes sense. What happens if the HSA owner passes away?
If your spouse is named as the beneficiary on the account, it's simple. The HSA just becomes their HSA. They inherit it and can use it just like their own, keeping all the tax benefits. However, if the beneficiary is someone other than your spouse, say, your child, the account stops being an HSA at the time of your death. The fair market value of the account generally becomes taxable income to that beneficiary in the year you pass away. It's an important point for estate planning.
That's a really thorough look at HSAs. Powerful, long-term tools, but definitely some rules to follow. Now let's shift gears a bit and talk about the other big player, flexible spending arrangements, or FSAs. How are these different? They also save you taxes, right? But they work differently.
Yes, FSAs are different beasts in several key ways, but they absolutely offer significant tax savings too, especially for managing predictable current year expenses. An FSA, or technically a health FSA, is an employer-sponsored benefit plan. You generally don't set one up on your own. It's offered through your job. How's it funded? Typically through voluntary salary reduction. You agree to have a certain amount deducted from each paycheck before taxes. And here's the key tax advantage. That money you contribute. It's not subject to federal income tax. And, crucially for FSAs, it's also exempt from employment taxes, that's Social Security and Medicare taxes.
Wait, so with an FSA, I save on income tax and the 7.65% FICA tax. That's different from the HSA deduction, isn't it?
It is slightly different. With your own HSA contribution, you get an income tax deduction, but you still pay FICA taxes on that income before it's contributed. With FSA salary reduction, the money comes out before both income tax and FICA taxes are calculated. So yes, you get that immediate payroll tax savings too. If you're in, say, a 22% federal bracket plus the 7.65% FICA, every dollar you put in an FSA only really costs you about 70 cents in take-home pay.
Yeah.
It's a direct boost. Employers can also contribute to SSAs, but it's less common than with HSAs.
Okay, so the big tax wins for FSAs are pre-tax contributions saving both income and payroll taxes.
Right. And number two, just like HSAs, tax-free reimbursements. When you use the FSA money to pay for qualified medical expenses, those withdrawals are completely tax-free.
Right.
So you're paying for known medical costs with dollars that have never been taxed.
Okay.
And there's one more really interesting, often overlooked advantage of FSAs that provides a fantastic cash flow benefit. It's called the uniform coverage rule.
Uniform coverage, what's that?
It means that the entire amount you elect to contribute for the whole year is available to you from day one of the plan year, even if you've only had a fraction of it deducted from your paycheck so far. Let's say you elect $2,400 for the year, $200 per month. In February, you have a big dental bill for $1,500. Even though you've only actually contributed maybe $400 through payroll by then, your FSA can reimburse you the full $1,500 immediately.
Whoa, so it's like an interest-free loan from your employer for early in the year medical costs.
Exactly. It's a huge benefit for managing cash flow, especially if you know you'll have significant expenses early in the plan year. You don't have to wait for the funds to build up like in an HSA.
Okay, that's pretty cool. So FSAs are employer plans. Does that mean self-employed people can't get one? And how does contributing work? Is it flexible?
You're right. FSAs are strictly employer-based. So unfortunately, self-employed individuals can't set up their own health FSA. As for contributions, you typically make your election once a year during your company's open enrollment period. You decide how much you want to contribute for the entire upcoming plan year. Your employer then deducts that amount from your paychecks periodically throughout the year. Now, the tricky part. Once you make that election, you generally cannot change it mid-year. You're locked in unless you have a specific qualifying life event, like getting married, having a baby, divorce, or a change in employment status for you or your spouse.
So you really have to estimate your year's expenses pretty carefully up front.
Precisely. You need a good handle on what you expect to spend because you can't easily adjust it later. And there's a limit too. For 2024, the maximum amount you can contribute through salary reduction to a health FSA is $3,200. That limit is indexed for inflation, so it might change slightly each year.
Okay, locked-in contributions, which brings us to that infamous FSA rule, the use it or lose it rule. This sounds like the big catch, the thing everyone worries about.
It absolutely is. The use it or lose it rule is the biggest challenge and the most critical planning point for FSAs. The basic rule: any money left in your FSA at the end of the plan year, you forfeit it. It goes back to your employer. You lose it. Poof.
Seriously, you just lose the money if you don't spend it.
That's the general rule. It forces you to estimate your expenses really accurately. Estimate too high, and you risk losing money. Estimate too low, and you miss out on tax savings. It's a balancing act.
That sounds stressful. Are there any ways around it? Any flexibility?
Yes, thankfully. Employers have two options they can offer to soften the blow of use it or lose it. But they don't have to offer either, and they can't offer both. You need to know your specific plan. Option 1 is a grace period. Your employer's plan can allow you an extra period up to 2.5 months after the end of the plan year to incur new eligible expenses and use the leftover money from the previous year. So if your plan year ends December 31st, you might have until March 15th of the next year to use up last year's funds on new expenses incurred during that Jan 25 Mar 15 window.
Okay, so a little extra time to spend it down. What's the other option?
Option 2 is a carryover. Instead of a grace period, the plan might allow you to carry over a certain amount of unused funds into the next plan year. For plans ending in 2024, the maximum carryover allowed is $640. Any amount you didn't spend above $640 would still be forfeited, but you get to keep up to $640 to use in the following year. This carryover gives a bit more flexibility, as the money just rolls into the next year's balance. You don't have to rush to spend it in a short grace period.
Right. But the crucial thing is, my employer's plan can offer the grace period or the carryover, but not both.
Correct. It's one or the other, or potentially neither, if the employer chooses not to offer either flexibility. This makes it absolutely critical that you find out exactly how your company's FSA plan works. Check your benefits guide, ask HR, does it have a grace period? Does it have a carryover, and if so, how much? Or is it strict use it or lose it? Knowing this completely changes how you should approach estimating your contribution. If you have a $640 carryover, maybe you contribute slightly more aggressively knowing you have a safety net. If it's strict use it or lose it, you need to be much more conservative.
Makes sense. Got to know the rules of your specific game. So what expenses can you actually use FSA money for? Is it the same list as HSAs?
Mostly, yes. The definition of qualified medical expenses for an FSA is very similar to the HSA definition. It follows that same general rule. Expenses that would qualify for the medical and dental expense deduction under IRS Publication 502. So again, that covers doctor visits, prescriptions, glasses, contacts, dental work, therapy, chiropractor, the usual suspects. And just like HSAs, this includes over-the-counter medicines without a prescription and menstrual care products for expenses after 2019. And yes, condoms too, per that recent notice.
Okay. And who can the expenses be for? Same as HSA.
Very similar. You, your spouse, any dependents you claim on your tax return. And also, importantly for FSAs, your child who is under age 27 at the end of your tax year, even if you don't claim them as a dependent. That's helpful for families with young adults on their plan.
Are there things definitely not covered by FSAs?
Yes, the big ones are health insurance premiums. You absolutely cannot use FSA funds to pay for your health insurance premiums. Also, long-term care insurance premiums or long-term care expenses are generally not eligible for FSA reimbursement.
How does the reimbursement actually work? Do I pay out of pocket and then submit receipts?
Traditionally, yes. You'd pay the bill, then submit a claim form with receipts or an EOB to your FSA administrator, which might be your HR department or a third-party company. They'd verify it and send you a tax-free reimbursement. However, many employers now offer FSA debit cards. These cards are linked directly to your FSA balance. You can often use them right at the pharmacy, doctor's office, or eye doctor to pay for eligible expenses directly. These cards have special systems to help automatically verify if the purchase is eligible, which really simplifies the process. Though sometimes you might still need to submit documentation later, it often makes using the funds much easier.
That debit card sounds way more convenient.
It really is. Oh, and one quick special note. There's a rule for qualified reservist distributions. If you're a military reservist called to active duty for an extended period, over 179 days, your employer's plan can allow you to receive any otherwise forfeited FSA funds as taxable wages. It's a way to prevent losing that money due to deployment.
Good to know. Is there anything I need to do on my tax return for my FSA, like that Form 8889 for HSAs?
Nope. And that's a key difference and a point of simplicity for FSAs. There are no direct reporting requirements for your health FSA on your personal income tax return. Your employer handles the pre-tax deductions. Those contributions simply aren't included in the taxable wages reported in Box 1 of your W-2 form. The reimbursements are tax-free and generally don't show up anywhere on your 1040. It makes tax time a little bit easier.
Okay, wow. We've covered a ton of ground on both HSAs and FSAs, the nitty-gritty rules, the benefits, the potential pitfalls. So let's try to tie this all together now. For someone listening trying to figure out their own situation, what does this all mean? How do you actually choose, or maybe use both? How do you strategize to really maximize those tax savings and manage healthcare costs? This feels like the payoff part.
It's exactly. This is where we connect the dots for practical planning. Let's start with a quick side-by-side comparison to really highlight their different roles. Think of the HSA as your long-term healthcare savings and investment account. Its superpower is that triple tax advantage: tax-deductible or pre-tax in, tax-free growth, tax-free out for medical. Key features: funds roll over year after year, no use it or lose it. It's portable, it belongs to you, not your job. But the big requirement: you must have a high-deductible health plan, HDHP. It's ideal for building savings for future potentially large medical costs, even into retirement.
Okay, HSA, long-term investment, portable, needs HDHP. What about the FSA?
The FSA is more like an annual spending account for current healthcare needs, tax benefits, pre-tax contributions, saving both income and payroll tax, and tax-free withdrawals for medical costs. Key features: subject to that use it or lose it rule, although grace periods or carryovers up $640 for 2024 can soften that. It's not portable tied to your employer. But importantly, it does not require an HDHP and its secret weapon. That uniform coverage rule giving you immediate access to the full year's funds, great for predictable near-term expenses.
That's a super clear contrast. So based on that, when does it make sense to really lean into one versus the other? Or for those lucky enough to qualify for both, how do you combine them?
Great question. The best choice or combination really depends on your personal situation, your health, your income, your savings goals, and what your employer actually offers. When does an HSA make the most sense? If you're generally healthy right now, maybe don't have a lot of predictable medical costs, or if your primary goal is to save and invest for future healthcare expenses, the HSA is usually the winner. Its long-term tax-free growth potential is huge. The portability means it's yours forever. If you're young and healthy, maxing out an HSA and investing it can create a substantial healthcare fund for later life, potentially even helping you retire earlier or more comfortably. It's a true healthcare investment strategy.
So HSA is great for long-term savers and investors, especially if current costs are low. When does the FSA really pull ahead?
An FSA really shines when you know you'll have specific medical expenses in the coming year. Think orthodontia for your kid, planned physical therapy, maybe expensive prescription drugs for a chronic condition, new glasses or contacts you get every year. If you don't have an HDHP and therefore can't get an HSA, the FSA is your go-to for getting tax savings on these costs. Or even if you could have an HSA, maybe you just prefer to use pre-tax money for these definite immediate expenses without touching long-term savings. That uniform coverage rule is also a big plus here. Need $2,000 for dental work in January. The FSA gives you access right away. For families with lots of small recurring costs, it can be incredibly useful for managing the budget with pre-tax dollars.
Okay, that makes sense. But you mentioned combining them. How does that work if having a general FSA usually disqualifies you from an HSA?
This is the pro-level strategy for those who do have an HDHP and are eligible for an HSA. You can potentially layer on specific types of FSAs to maximize tax savings. While a general-purpose health FSA blocks HSA contributions, you can often participate in a limited-purpose FSA, LPFSA, alongside your HSA. What's that? An LPFSA can only be used for eligible dental and vision expenses, maybe preventive care too, depending on the plan.
So I use the LPFSA for my glasses and dental cleanings and keep my main HSA funds untouched to grow or for major medical stuff.
It's a fantastic way to double dip on tax benefits. You use the LPFSA with its pre-tax contribution saving income and payroll tax for those predictable dental vision costs. This preserves your HSA funds entirely for other medical expenses, or better yet, allows them to stay invested and grow tax-free for the long haul. It optimizes savings across both accounts. There's also another, less common option, a post-deductible FSA. This type of FSA can only reimburse general medical expenses after you've actually met your main HDHP deductible for the year. So it helps cover costs in that post-deductible phase with pre-tax dollars, again, potentially saving your HSA funds.
Wow, using an HSA and a limited purpose FSA sounds like a really smart way to squeeze out extra tax savings if you have an HDHP.
It absolutely is for those eligible. It requires understanding your employer's specific offerings, but it's often the most tax-efficient approach.
This has been incredibly illuminating. Okay, as we start to wrap up, Let's crystallize the key action items. What are the absolute must-dos for smart planning? And maybe more importantly, the big mistakes to avoid. What should people listening be thinking about right now?
Okay, number one, especially for FSAs, estimate carefully. That use it or lose it rule is real. Track your spending for a year if you need to. Get a realistic handle on your predictable cost to avoid forfeiting money or leaving tax savings on the table. Understand your plan's grace period or carryover option that's crucial to your estimate. Number two, for HSAs. Know your eligibility rules cold, especially that last month rule risk. If you use that rule to max out contributions, be certain you'll maintain qualifying HDHP coverage for the entire 12-month testing period. The penalty for failing is steep income inclusion plus 10% tax. Same goes for the testing period if you do an IRA rollover. Don't gamble with eligibility.
Right, don't get caught by those testing periods.
Yeah.
What else?
Number three, for both HSAs and FSAs, record keeping is paramount. I know I sound like a broken record, but it's that important. Keep every receipt, every EOB, every bill related to expenses paid with these accounts. Organize them. Be ready to prove every distribution was qualified. With that proof, the tax benefits can evaporate under scrutiny. Don't be lazy about records.
Okay, estimate, watch eligibility, keep records. Anything else?
Finally, number four, check your specific plan details.
Oh.
Always. Don't assume your FSA works like your friends at another company. Don't assume your HDHP covers preventive care the way you think it does. Talk to HR, read your benefit summaries, check with your HSA custodian, ask specific questions. Do we have an FSA grace period or carryover? What's the limit? What preventive care is covered pre-deductible by our HDHP? Are limited purpose or post-deductible FSAs offered? Verify the details for your situation.
That's great practical advice. So we really have taken a deep dive today, haven't we, into HSAs and FSAs. We've picked apart their unique tax benefits, how they work, and how you can use them strategically. We've seen HSAs as these amazing long-term portable savings tools with that incredible triple tax advantage, perfect for investing in your future health. And we've looked at FSAs as powerful annual tools for immediate tax relief on known expenses, but needing careful planning around those use it or lose it rules, or maybe the carryover options.
Exactly. And the real takeaway, the core message, understanding and using these accounts isn't just about nickel and diming your tax bill. It's about making smarter financial choices, choices that directly affect how you manage healthcare costs, how you save for the future, and really how you optimize your whole financial picture. These aren't just lines in the tax code. They're practical tools the government provides to empower you to take more control over healthcare spending, which is, let's face it, a huge financial uncertainty for most people.
So what's the bottom line for you listening right now? It's that these accounts aren't just abstract ideas. They're real, accessible ways to be smarter with your money, cut your taxes, and build financial security. Yeah, keeping track of all these IRS rules can sometimes feel like, I don't know, financial whack-a-mole. But that's why we do these deep dives for you. So here's a final thought to chew on as you go about your day. Something provocative, maybe. How might truly optimizing your HSA or FSA, really squeezing every bit of value out of them, do more than just save you taxes each year? How could it fundamentally shift your approach to planning your entire financial life, even retirement? Think about that peace of mind, having a dedicated, growing, tax-advantaged fund just for healthcare sitting alongside your 401k or IRA. Maybe take a fresh look at your current health plan, your employer's benefits package. With all this new knowledge, you might just find a financial superpower you haven't fully tapped into yet. Thanks for joining us on The Deep Dive.